started this series of IFRS masterclasses a while ago, but now what we are doing is we are running it on a weekly basis. And the preceding week and the week before that, we spent time on IFRS 15, step one, step two, step three, a detailed discussion on that. But we'll be concluding the five-step analysis with a discussion of step four and step five. Now, just to give you how exact for those who are attending this for the first time, just to give you a glimpse of how the masterclass goes. There's a discussion that we do with respect to a particular topic, and we discuss the entire concept. We discuss the entire concept, and after that, the floor is open for questions. And any questions that you have with respect to this standard, with respect to uh, any other accounting standard that you want me to take up, then we'll discuss those aspects also. So, yeah, I'm Satyamid Nandedkar. I am a chartered accountant. Yeah, I have also completed my USCMA and CS, and I have been a trainer for IFRS and for SBR and for ACCA for the last, I don't know, 6 years now. By now, it's been 6 years. I also train CA students, and I have started this masterclass in order to, bridge that gap between, what students want and what students want to know and what the course has to offer. So all questions that you have on this standard and on anything else, of course, we will accumulate those questions and we'll take these ahead. So, okay. In the last two sessions of this edition of the masterclass, as an IFRS 15 edition, at length about the first three steps. Okay, what were the first three steps? First of all, identify the contract. That was the first step. Then we identified the separate obligations, and then we noted down the transaction price also. There were four elements in transaction price that we were very, very interested in. What were these four elements? These four elements were the variable consideration bit, the non-cash consideration, consideration payable to customer, and the existence of a significant financing component. Now, what we are going to do is we are going to talk about the fourth step, which is allocation of transaction price, and the last step, which is revenue recognition. So let me share my screen and then we can take it from there. Okay. So the fourth step is allocation of transaction price. The total transaction price should be allocated to each performance obligation in proportion to standalone selling prices. Now we saw what is the meaning of the term transaction price. Primarily, what transaction price means is the consideration that is payable for performing the contract. So if my contract is to teach you CA final financial reporting, then you're going to pay me for that. Say you have promised to pay me 15,000, that becomes my transaction price. Now what they are saying is, see, if there is a single performance obligation, it is not a tough task or a calculation anyway. The calculation becomes slightly tricky when you have multiple performance obligations under the contract. Now, when I say multiple performance obligations, there could be a case that I am offering you coaching also, and I'm offering you counseling also, and I'm offering you some test series also. So there are three separate performance obligations, and these days all the coaching providers and everyone, they talk about combo offers. That as if they are standing in a supermarket and saying ki, "Arey, ek sabun pe something else is free, washing brush or something." This is unfortunately how educational institutes also act. But let's no harm in calling a spade a spade. Let me give you an illustration of how exactly do you split the transaction price. Say, for example, Satyamed offers the following combo offer to the students, CA Final FR. And what is it that Satyamed offers? Satyamed offers them three things: coaching, he offers them test series, and he offers them career counseling. And the price of this combo offer is 28,500. Now the question is, how much revenue should Satyamed recognize? He has done the coaching bit. He is yet to provide the test series, and he is yet to provide the career counseling part. Now, Satyamed has finished the first obligation, which is teaching. The question is, how much revenue should he recognize? See, we'll start with a simple example, then we'll add more and more complications to it as we move along. How much revenue should he recognize? I'm sure none of you thinks that 28,000 divided by 3 allocated equally. That's not how it works, because all three activities require different amount of time, different amount of commitment, different amount of effort. So you cannot just club all the three together. Okay. So, and Satyamit sells this as a combo, but he also sells it as individual products also. So somebody can come and join only for, somebody can come and join only for test series, somebody can come and join only for counseling. So Satyamit offers individual services also. Okay. Satyamit offers individual services as well. They are priced as a, how does Satyamit price each one of them individually? It's in this way. Say the coaching is for 20,000, the test series is for 6,000, and the counseling is for 4,000. Now, what are the standalone selling prices? Standalone selling price means if sold just by itself, not in a combo, the standalone selling prices are coaching 20, test series 6, and counseling 4. What does the accounting standard say? The total transaction price should be allocated to each performance obligation in proportion to the standalone selling prices. Okay. So, the coaching, so the total transaction price of 28,500, 28,500, that is total transaction price, should be allocated to the three obligations in proportion to their standalone selling prices. Okay. So we write down this, then we write down standalone selling price. Okay, we write down the standalone selling price, and then we allocate 28,500 in that ratio. So see how the allocation is done. It's again not a very uh, tough aspect, but of 28,500. This is the, so I take the total three and I add it in the ratio of the standalone selling price. So how do I do it? 28,500 into 20,000 upon 30,000. 28,500 into 6,000 upon 30,000, and 28,500 into 4,000 upon 30,000. What is the total? Naturally, this is a split of 28,500. So this is the total. Now, if Satyamit has finished the obligation of teaching, okay, if Satyamit has finished the obligation of teaching, he can recognize 19,000 as his revenue. You should not divide it equally. It should be split in the ratio of the standard selling prices of each component. Now, if you think about it, a discount has been offered. है ना? A discount has been offered. And what is the discount? 20,000 minus this. Even the discount is split in the ratio of the values of standalone selling prices. If standalone selling price is not directly observable, then it must be estimated. Observable inputs should be maximized. Observable inputs, I'm basically talking about the fair value of these items, for which IFRS 13 becomes the source of guidance. Now, you could have any number of situations or any number of performance obligations. As long as you know the standalone selling price, it is possible to allocate the standalone selling price in proportion it is possible to allocate the standalone selling price in proportion, in that proportion, and your total billing, which was 28,500, gets split accordingly in this particular ratio, and you can recognize the revenue accordingly. You have a product wise discount also. See, the total comes to 1,500. You have individual product wise discount also. So when the company wants to, prepare its management accounts and it wants to see which service got in how much revenue, that data is also easily available. And from a financial perspective, by the end of March, I have finished coaching, so I will recognize 19 as revenue. Later on, when I finish the test series, I will recognize 5,700 as revenue. And when I provide counseling, then I will recognize 3,800 as revenue. So this is the fourth step. You allocate the transaction price, and after that comes the most important step, which is recognize revenue. Now, all our effort has come down to this point in the discussion where we are answering the question, when exactly should we recognize the revenue? Now, the question, when exactly should I recognize the revenue, is an important one. Revenue can be recognized only when the performance obligation is complete. Now, think about a situation that I have a list of performance obligations and I have taken some deposit from the customer. Let's assume that somebody has joined me for the entire coaching package and I am collecting 5,000 as security deposit. This security deposit is non-refundable. Let's assume that that is, booking fee for taking a seat in the batch, and that money is never going to be refunded. Now, even though this is a non-refundable amount, it cannot be recognized as revenue until the performance obligation has been satisfied. So when the candidate joins and you start teaching, and probably the first subject or a couple of lectures are done, and finish that part of the performance obligation, only then you can go ahead and recognize the revenue. Just because a particular collection from the customer is non-refundable, okay, just because a particular collection from the customer is non-refundable, you should not you cannot call it your revenue, because the performance, it all depends on satisfaction of the performance obligation. Now we are going to look at when to recognize revenue. Should you recognize it at one point in time? Should you recognize it over a period of time? That is the focus of discussion. Now let's understand, let's get into proper detail of what is the specific point in time at which revenue should be recognized. There are two things. Either the performance obligation is satisfied at a point in time, you come to buy this phone, I transfer the phone to you, this becomes your phone, performance obligation is complete, I am entitled to revenue, I am entitled to collect the money from you. Second situation is, say for example, I have taken up annual maintenance of the water filter at your house, which means I have collected, for example, 12,000 rupees in advance, and I give you a monthly visit in which I open the water filter, clean it, repair it, and go. So this is an obligation that is satisfied over a point in time. It is not satisfied at a point in time, it is specific, it is satisfied over a point in time. So this particular activity of revenue recognition uh, is incumbent on when the performance obligation is satisfied. When I sold you the phone, I transferred the phone in one go. You took the custody of the phone, you got control of the phone. Second case is, the promise is to do it for 12 months, which means the obligation is satisfied over 12 months and revenue recognition should happen accordingly. Now, IFRS 15 lays down three conditions in which it says that if this is happening, then the performance obligation is satisfied over a period of time. And keep one thing in mind. The first point that the accounting standard stresses on is, it says check first whether the criteria of satisfied over a period of time are fulfilled. If none of those criteria is fulfilled, then you go and check whether the performance obligation at a point in time wala condition is fulfilled. So let's understand what are the three subdivisions or sub classifications under the clause satisfied over a period of time. The service is being offered over, you are fulfilling your promise over a period of time. So the first one is customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. So if you have joined my class for financial reporting, it's a 4 month class. I am teaching and you are simultaneously receiving the benefit out of the teaching activity. So my performance and your consumption goes hand in hand. My performance happens over a period of time, and your consumption of that service also happens over a period of time. If the service that I am providing is 12-month contract for servicing and maintenance of the water filter, I provide the service and you consume the service simultaneously. This happens over a period of 12 months. So customer enjoying or receiving the service and a company providing the service happens simultaneously. The second part is entity's performance creates an asset. For example, work in progress that the customer controls as the asset is created or enhanced. Say, in this case, we could think of, a contract where if I'm a carpenter and you have gotten in touch with me to create furniture for your house. So I start working on the furniture, I cut it, I polish it, I'm starting to piece it together. And as I create that particular furniture, you get control over that particular furniture. What do you mean by control? Control is the ability to direct the use of that particular item. So if you have entered into a contract with me and that is for creating furniture for your house, I have done 50% of the work. You have the right to tell me leave it right now and leave as it is. So I am the service provider or the goods provider is making the furniture, and you are getting the ability to direct the use of that particular furniture as I am creating it. And third situation is entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed till date. Let's go back to the same furniture wala example, but in this case the customer has asked me to create customized furniture exclusive for his house. This is not, we are not talking about a Neel Kamal chair or, ready-made furniture. I have commissioned someone to make it as per the dimensions and design that I want. And the seller gets the right to ask for payment for the proportion of work done. So if 60% of the furniture making is done, he has the right to ask for 60% of the contract value in return. And the point is, the entity's performance does not create an asset with an alternative use to the entity. What do you mean by does not create an asset with an alternative use? If I am making customized furniture for someone, then it can be sold only to that specific customer. I cannot keep it with myself. I cannot spawn it off to some other customer also. Only that person who commissioned the manufacturing of this furniture, who commissioned the making of this furniture, has the right use for it. So whatever I am creating as a carpenter, it cannot be sold to anyone else. It does not have an alternative use. It can be sold only to the person who gave me this order. And I have the right to demand progress payment. If 60% of the work is done, I have the ability to demand payment for 60% of the contract price. If any of these three conditions are fulfilled, then you say that the performance obligation is satisfied over a period of time. What are the three conditions? Let's quickly revise. My performance and your consumption of the service goes hand in hand. Okay, my performance and your consumption of the service goes hand in hand. There is simultaneous happening. Second case, the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. You could also think of, someone coming to your house and doing painting work for you. Now you are already living in a house and that person is painting. So if there are 5 rooms and he has finished painting of 2 rooms, naturally I get to direct the use of those particular rooms. I get to tell him how to paint, what to do, what not to do. The total job was to paint 5 rooms. He has finished painting of the two. The obligation is getting satisfied over time. And the third one, performance does not create an asset with an alternative use to the entity, which means the asset is unique. Whatever is coming out of my activity, that is a unique activity. No, nobody else gets to control that asset, and I cannot sell it to someone else also. It has to be sold only to the customer who placed that order. Was made according to his customization, it was made according to his specification. Nobody else will accept also that particular. So in this case, in the third case again, you say that the performance obligation is satisfied over a period of time. Now let's understand that if we have established this fact that performance obligation has been satisfied over a period of time, then how do we account for revenue? Ideally, I mean, revenue recognition is basically ek hath do, ek hath lo. If you are saying that I have done 20% of the work, you should get paid for 20% of the work done. If you say that I have done 70% of the work, I should get paid for 70% of the work done. So in IFRS 15, the accounting standard specifically mentions that if the performance obligation is satisfied over time, then you should recognize revenue on the basis of what? You should recognize revenue on the basis of the proportion of work done. And how do you measure the proportion of work done? There are two methods that the accounting standard accepts. What are these two methods? The first one is the output method. The second one is the input method. The output method is basically, maybe you uh, survey the work done and you come to a conclusion that okay, 50% of the construction work is complete. For conducting this, see, you and I are not experts on construction, so we can't go to a site and say, oh, 30% hua hai ki 40% hua hai. The evaluation of this, the survey of this has to be done by a person who is expert in that particular field. He will give a written certificate which will talk about the percentage completion done, and on the basis of that, we will recognize revenue at the end of the year. Or you could also think about time elapsed. For example, I have a commitment with an organization that I will give you 100 hours over the next 3 months for some activity. I have done my job for 40 hours. So that is a measure of the performance that I have done. And that becomes my basis for deciding how much work is done and how much revenue can be recognized. The second approach to doing this is input method. You see how much, say for example, you were supposed to incur the expected total cost that you were supposed to incur for a particular project is 1000 rupees, and you have incurred 350 costs so far. Then it is safe for you to assume that 35% of the work is done, because if the total expected cost was 1000 and you have incurred 350, that would mean 35% of the work is done. But the problem here is, what if there is an inflation? What if the original standard has not been revised, in line with the inflation that has taken place in the economy, and 350 is an inflated figure of cost and actual percentage completion is only 25%. That would lead to an incorrect calculation and revenue recognition will be flawed. So in such cases, a better approach would be to do a performance survey and then come to a conclusion in terms of how much of the total work has been completed. I see. Yes, Shabaz, you have a question. You can type it out in the chat box also in case the mic is not working, no problem. Or you can wait till the end, or you can ask now, whatever works for you. That's completely fine. Okay, so with this in mind, we get an idea of what all is, how do you calculate the completion of performance? How do you evaluate how much work has been done by you? Once these things are put together, you will, by the end of the year, you will conduct a survey of the total work done. You will have a conclusion that 35% of the work is done. Then you can recognize revenue to that particular extent. Okay, you can recognize revenue to that particular extent. Now let's get an understanding of what happens after that. I have understood, for example, I have come to a conclusion that 35% of the work is done. Now when I say 35% of the work is done, I want to recognize revenue. But so that means, I will credit sales. For example, 35% of the work is done. What do I debit? I have still not uh, created a created an invoice for the customer. So what I do in this case is I record an entry by unbilled revenue account debit to sales revenue account. Okay. So say for example, I know that I have to recognize revenue of 350. But it might happen that the contract specifically says that you can make four billings in all overall, and each of the bills has to be 25% of the contract price. I mean, the excuse me, the contract could say anything. That would be a mutual decision between the parties. So at the end of the year, I would record this entry: unbilled revenue account debit to sales revenue. Unbilled revenue is a current asset or a non-current asset, depending on, when do you intend to collect. Mostly these are current assets only, unbilled revenue. But say this entry I was recorded at the end of the year on 31st of March 24. Okay. Why am I calling it unbilled revenue? See, I have to debit something. I cannot debit debtors because an invoice has not been raised so far. I have to debit something. I cannot debit cash. I cannot debit bank. So I debit unbilled revenue. Unbilled revenue to sales revenue. This is a current asset. And of course, this is revenue. This goes to P&L. Now, in the next year, as per the billing terms in the contract, on 1st of May 2024, the company sends an invoice to this customer for 250. So now you have raised an invoice on the customer. Now money is receivable from the customer. What account entry will you record? Say the name of your customer is Anupam. So by Anupam account debit, now the money is receivable from this person. Now I won't credit sales revenue again because it has already been credited when it was recognized. Now I am going to credit unbilled revenue. It is no more unbilled. It has been billed to the customer. And naturally, when the customer pays, I will record an entry: bank account debit to Anupam account. So these are so this is how the unbilled revenue part also works. Now I'm sure people who are working in GST, they run into the word unbilled revenue on many occasions, especially when you are doing GSTRO. The season is right around the corner. At least back in the day, these were the due dates when I was still actively working in GST. But when you prepare your GSTR 9 and GSTR 9C, the unbilled revenue is an important part of the reconciliation process. Unbilled revenue is basically recognized revenue but not yet billed to the customer. That is also you could also call it a contract asset in a certain sense. And you could also have a situation where billing has not yet happened. Okay. And revenue recognition has also not happened. We could have that situation also. Say, uh, let's talk about situation 2, extension of the above. In Feb, or it's a modification of the above situation. Okay. Customer 2 pays us, say, 500 in March 2025. Okay. So by bank account debit, okay, 2, you could also call it advance from customer, but here I'm calling it contract liability. Okay. To contract liability account credit. How much? 500. and survey was done, and the percentage of work done was identified as 30%. So 30% of the total amount can be recognized as revenue. 30% of the total amount can be recognized as revenue. Now, uh, we have a contract liability, and we have to now make sure that, see, this contract liability of 500, we can recognize 30% of the amount as revenue. So we'll have to ensure that the contract liability gets eliminated and revenue is recognized to that extent. Here you will also have to be cognizant of the fact that you will have to first of all bill the customer, right? The customer has given you money, you will have to bill the customer first, because that billing part is also important. Now, uh, all of these aspects will have to be taken into consideration when you are closing your books of accounts at the year end. So contract liability, when he paid you, say he paid you in the first week of March, at that time you recorded the entry bank to contract liability. But later on, when the revenue was recognized, the accounting entry will change. So we'll have to take that part also into consideration. So by customer account debit, you have to send him an invoice, right? To sales revenue. Okay. How much? 300. Customer account debit to sales revenue account. And now what happens? See, you are not going to collect any cash from him because he has already paid you. Now you can't expect him to pay you again. So what will be the entry? By contract liability account debit, advance from customer basically to customer account. So this has been knocked off. This is revenue recognition. This is knocking off the debit receivable in the customer account, because nothing is technically receivable. He already paid you when he made that advance payment. So on 31st of March 25, we will have the following values in financial statements. You will have contract liability of 300. You will have contract liability of 200. You will have revenue of 300, and this is how you will round it up. Yes, tell me, you have something to say? You can't hear me? No one can hear me? Guys, can someone else apart from Smriti tell me whether you can hear me or not? Yes, Veena? I think I'm getting a thumbs up, so I presume the thumbs up means you can hear. वॉइस नहीं आ रहा है, वी कैन हियर यू। आई थिंक एक दो लोगों को कुछ प्रॉब्लम हो रहा है। मे बी यू कैन ट्राई एग्जिटिंग एंड rejoining the session. Maybe that can help. Okay. So is everyone with me so far in terms of unbilled and debtors and all of that? Yes, of course. Please tell me, Pankaj, what is your question? Yeah, go ahead, go ahead. You can type out. So the question is, sir, if we have received revenue, why did you mention the customer instead of bank? Which part? Okay, this one. So see, we have received the money. ठीक है, customer 2 pays us 500, say for example, let's change the month. He pays us 500 in Feb 2025. Now, on Feb 2025, the work was not complete, or maybe the work was not started, or it was in the very initial stages. But survey was done, and When was this identified as 30%? This was done at the end of March 2025. So he gave us the money in February when the work had probably not started. Customer 2 pays us money in Feb 25 when the work was just started. ठीक है? So, which is why Karthik, I first of all recorded bank account to contract liability, and then when I actually had a certificate saying that 30% of the work is done, then I recorded an entry customer to sales revenue because I had to bill the customer. So I then recorded the entry customer to sales revenue. But now money is not receivable from the customer. So I followed that up with the entry contract liability account debit to customer account. Now, contract liability, advance received from customer, deferred income are more or less, I wouldn't say exactly the same, but they are 95% synonyms of each other, which means they mean one and the same thing. Now, all of these are fairly new terms, that financial reporting has started incorporating in India. When I was studying to be a chartered accountant, I'm talking about 2010, 11 back then. We mostly called it advance receipt from customer only. We rarely called it, deferred income and contract liability. All of these things started evolving later, and the terms that we use today are far better because the word advance from customer does not do complete justice to the actual nature of the transaction. Veena, you have a question. I see that you have raised your hand. Could you please tell us what the question is? Or maybe you can type it out. Okay. So that was revenue recognition over a period of time. Now, when the revenue is, if performance obligation is not satisfied over a period of time, then it is satisfied at a point in time. Do not make the mistake of assuming that over a period of time is for services and at a point in time is for goods. If you have, say, for example, you're going for a movie, the movie is not a good. Watching that movie, that experience is a service. that service is satis- that service is completed in one go. You go to the theater, watch the movie for 2 hours, and you come home. So this particular performance obligation is satisfied at a point in time. Now, yeah, Pankaj, let me just finish this, then you can speak. Let me finish this particular part. So, performance obligation satisfied at a point in time. How does the accounting standard proceed? It first of all tells you that if 1, 2, 3 are satisfied, that means performance obligation is satisfied over a period of time. 1 or 2 or 3, the three conditions that we saw. If none of these three is fulfilled, then it says that means the obligation is satisfied at a point in time. And when is the performance obligation satisfied? It is satisfied when the entity controls an it is satisfied when the control of the asset passes on to the other person. Now let's understand the meaning of the word control, and we will run into word on many occasions. Specifically, when we discuss consolidation, we will run into this word. Now, tell me something. How would you, when would you say that you control something? When you get to decide what to do with it. My colleague has gone out somewhere, and because of that, I take delivery of a TV that he has ordered for himself. I keep it in my house. I can't decide what to do with it. It is lying there and I can't touch it. I can't open it because I don't have the ability to direct how to use that TV or what to do with it. But had I purchased it, I would have full freedom to do whatever I want. I could install it in my drawing room. I could smash it down with a bat and throw it on the road. I have full control on what to do with it, how to do with it, how to handle it. Now, if this is the idea, we have to understand one more thing. Ki, to talk about control, there are certain indicators which will, help you to understand whether control has passed on from one entity to another, from one party to another. What Indicators of transfer of control. Indicators of transfer of control. See, again, the accounting standard doesn't say, "अरे ये पांच में से three conditions fulfill हो गया, so that means control has been transferred." It relies on two basic principles. The party who has it, anybody who has the ability to direct the use of that particular item, what to do with that particular item. Think about a bill and hold arrangement. Okay, I go into a shop and particular TV and I like that color. Specifically, I like that color. So I say, okay, purchased, give it to me. But I tell the shopkeeper that, listen, I'm going for a I'm going for a 3 week long holiday. I can't take it home right now. I'm on my way to the airport. तुम इस टीवी को निकाल के रखो स्पेसिफिकली, डोंट गिव इट टू एनीवन, ये टीवी मेरा है, तुम ये टीवी को मेरे लिए निकाल के रखो, कीप दिस टीवी फॉर मी, डोंट हैंड इट ओवर टू एनीवन एल्स. He says okay. Then he puts a sticker on that TV. He still keeps it in the display, but he puts a sticker on that TV which says sold to Satyamed. He is only taking care of the TV on my behalf. Now the and I have paid, maybe I have not paid, whatever it is, but I have identified the TV. He has demarcated the TV and he has put a sticker on it, sold to Satyamed, not for sale. That means who has the ability to direct the use of that particular TV? I have the ability. I, as in the customer, the seller doesn't have it. So, although physical custody has not come to me, still that TV is very much mine because I now get to decide what to do with it. In some cases, the physical custody might be given to you, but the legal title has not come to you. What is important? Ability to direct the use of that particular item. The first example that I gave, my friend's TV is with me. I can't use it. I don't get to direct the use of that particular item. No control. Second case, I don't have the physical custody. Somebody else has the physical custody, but it is demarcated in my name. I get the right to decide what to do with it. So, to have control, you should have the ability to tell the other person what to do and what not to do, or to decide how to use that particular item. Second defining criteria is the risks and rewards of ownership. What do I mean by risk and reward of ownership? So, if I'm talking about, say for example, we are talking about goods which I have ordered from some other location. There are different incoterms. Incoterms matlab shipping terms are different. Sometimes the shipping terms are free on board. Sometimes the shipping terms are CIF. Different shipping terms are there. What if the contract says that, Pankaj is in South Africa and he is sending some goods to me? What if the terms of the contract say that the goods become, all the responsibility of goods will remain Pankaj's till the goods are offloaded in Mumbai? That means although he has shipped the goods, he has sent me the invoice, I have paid him probably, still who is the who is the person responsible for the goods? Pankaj. If the goods get destroyed, it is his problem. If uh, and if they come to me and I pay him, that is again his benefit. What if the shipping terms tell you that the moment the goods are put on board of the ship, at that point itself, the custody passes on to Satyamed, the ownership and risks and rewards pass on to Satyamed. So, if anything goes wrong with the goods, if the ship capsizes and drowns or something else happens, Satyamed is responsible, not Pankaj. So, that point where where all the risks and rewards pass on to the other person, most importantly when the other person gets the ability to control that particular item, is when you say, okay, transfer of control has happened, hence recognize revenue. Unless and until transfer of control has happened, you cannot recognize revenue. One point that you need to keep in mind is, see, there are certain conditions written here, that entity has a present right to payment, there is legal title, physical possession has been transferred. Most important part is that the customer gets the ability to direct the control of the asset, to direct the use of the asset. Keep that TV example in mind. It will throw some light on who is deciding what to do with this particular item. That is where you can say that performance obligation is satisfied at a point in time. And the date the transfer of control happens is the date we recognize the revenue. So this is the fifth and the final step in revenue recognition, which is recognition of revenue. We went through the whole 5-step model. And see, the accounting standard is far from over. Uh, there are other aspects also that we'll have to discuss, but this is the broad stroke of 5 steps in the accounting standard. Okay. Naresh, you are saying I'm still confused. So can you tell me what is the point of confusion? Could you type it out, or if you want to unmute and speak, you can unmute and speak. If you have any doubts, you can let me know. More than happy to clarify. Yes, Veena, tell me, how can I help you? We have no right to speak means you can't unmute. Let me, oh, 1 second. Um, I'll ask. There's someone, who's the meeting host. I'll just message that person to.
Done, sir.
Mm-hmm. Now you can
Yes, sir. Now I can.
go ahead. Go ahead.
So, sir, basically my question is regarding to IFRS. Basically, I let me tell you with the one example. Suppose that the company has sale any product in the month of December of 1,000 rupees, and the company has received the money, right? But
Mm-hmm.
like there is a policy in company, if any has purchased any product, so we will give a like 10% of store credit. So
Mm-hmm.
whenever they will buy any other product in future months, so they can utilize the amount like fully amount of 50%. So my
Correct.
question is that like how can we how can we treat these discount in the books of account like as per IFRS provision?
So this is, this the point that you raised. This is step 3 of revenue recognition, where we spoke about transaction price. Consideration payable to a, this is an amount which has to be either paid to the customer or adjusted with his future purchases, right? So whenever there is a store credit or accumulated, loyalty points or anything, the business entity will have to adjust it against the total revenue and record only the net revenue.
Okay.
Yeah.
So actually, basically, I have missed that. I guess point number three. So, is there any possibility to receive the like PDF and some kind of notes?
Yes, I will send it. I can, of course, I'll upload the session on my YouTube channel. The first session was uploaded. The second one has not been uploaded yet, but I will upload it, including today's session.
Okay, thank you so much. It will be very clear. Thank you so much.
Yes, Rupeshani, you have something to say. I can see that you have raised your hand. Veena, do you have a question that you would want to ask or something that you want to share with us? Now, all of you, so the masterclass sessions have been started with one objective, as I told you, to bridge the gap between what the exam expects and what we know. And sometimes a lot of basic things that your employers or your coaches or anyone, they go ahead with the assumption that you know the basics, and sometimes there is a small gap that is there. So the IFRS master classes have been started with that objective in mind. So see, IFRS 15 is far from complete, but we have done the 5 basic steps of IFRS 15. So in the future, you could let me know if you want me to go into other aspects of IFRS 15 only, where we'll discuss warranties, where we'll discuss, so there are different areas that we could discuss within IFRS 15 for 2 more sessions, or we could start with a new accounting standard also. That is also fine with me. And you could tell me what you want. For that, as I have been doing in the past couple of sessions, see, I'm posting the link for my LinkedIn profile. So I request you to connect with me there. You can send me a DM, connect with me, send me a DM in terms of what you would want me to take up, and I will take that up accordingly. Also, for Indian chartered accountants, for students who are pursuing chartered accountancy, for those who want to do the diploma IFRS course, for those who want to do ACCA, any questions that you have, you want you want to do CMA, whatever it is, any questions that you have in terms of, the career progression, or you just want to have a chat or a discussion, again, I would request you to connect with me, and, we can fix a slot, and, we can have a proper meeting where a 30-minute discussion where we can discuss any questions that you have on an accounting standard, or in terms of specific career related questions also, more than happy to address. If not you, somebody around you has these questions, more than happy to address that part.
So, sir, basically, like where we have to connect, like on LinkedIn or some kind of like we can get. I know you will get many messages on LinkedIn, so it is difficult for you to respond everyone's.
So LinkedIn is one place, because
Yeah, I know.
I'm also heavily obsessed these days with LinkedIn. That is one place where I answer most of the questions, but I'm still giving you my number,
Okay,
the
sir.
chat box, everyone, 7709041555. My name is Satyamed Nandedkar. Uh, I don't check my messages with that regularity, but LinkedIn I check, and I have a team also that helps me with LinkedIn. So be assured that your questions will be answered quicker on LinkedIn than on any other platform.
Okay, so basically, I need advice on like basically I am thinking about to do diploma in IFRS. So my question is that from where should I do and that kind of.
Yes.
Yes.
Understood, understood. So we can definitely connect for that. Just, everyone just requesting all of you to put your connect with me.
Yeah.
Acha, one more point. I have put a link to my YouTube channel also. So IFRS 15 is a bigger concept, which is why it went on for 3 sessions. It might go on for two more if you guys want. But the smaller accounting standards like IAS 20 and 16 and all of that, those are already uploaded on the YouTube channel. So you can watch some of the concept there also. And yes, Vishal, I can help you with the notes and the lectures, no problem. Just connect with me on LinkedIn. I'll send all the notes there. So whatever request you have, just let me know. I'll get it processed for you. And if you want some sort of recommendations and all of that, again, more than happy to get on a discussion with each one. Just let me know what your ask is, and we'll work on that. Thank you. Anyone else, any other questions that you have, please let me know. And as I told you, messages mein thoda sa reply gets a little late, but LinkedIn and all happens with regular frequency. So yes, I think Ravi had a question that I missed. Will revenue recognition impact warranty accounting? Yes, revenue recognition will impact warranty accounting. There we'll have to work with IFRS 15 and IAS 37 together. So if all of you want the next session to be on, you know, that part, other aspects of revenue, I'll take it up on other aspects of revenue, no problem. And we could do one more thing. We could do one more thing. Uh, we could, I'm planning on, building a community for IFRS online, IFRS and other aspects of financial reporting. So if you could, message me on LinkedIn that you want to be a part of that community, I'll add all of you, and then, we can take up other topics that you specifically want to discuss. So whatever works. Okay? Chalo. Thank you so much, guys. Have a good day.
Thank you so much, sir. Bye bye.
Bye.
Thanks everyone.
Thanks,
Thank you,
everyone.
Satya.
थैंक यू सो मच सर, थैंक यू सो मच सर। आपका नंबर मिल सकता है?
हाँ, नंबर भी है, लिंक्डइन का प्रोफाइल भी है, मैं आपको सब दे देता हूँ। लिंक्डइन पे आप कनेक्ट करेंगे तो मैं तुरंत आपको रिप्लाई कर पाऊंगा। ठीक है?
अच्छा ओके, तो मुझे शेयर कर दो ना सर आपका लिंक्डइन का आईडी।
मैंने भेज दिया। चैट बॉक्स में डाला है।
ओके
जी।
ओके सर, मैं देखता हूँ।
थैंक यू। थैंक यू। बाय। थैंक यू। हैव अ ग्रेट डे। बाय।
Hello, 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 hello.